Hello and welcome to Join Our Town. I'm your host, Kelly Waldauer. I'm so glad you have joined us today. Today we're going to be talking about credit scores and fixing your credit score. And it's probably something we've all heard about, but we might not know all the ins and outs. And joining me today is Stephanie Bittner, who's Community Outreach and Education Manager for Clarify, which is a nonprofit that used to be called Consumer Credit Counseling Service. Stephanie, thanks for coming in today.
Great to be here, Kelly.
So we've all heard the term credit score, credit report, fixing your credit. And it seems like everybody these days has a loan, but can you define credit for us and what that means and how it applies to obtaining a loan or a mortgage?
Yeah, basically credit is our ability to pay back money that we borrowed and the trust that that lender has with us that we're going to, uphold our end of the bargain and make those payments and pay them back.
So it's that we have the credit, that they're giving us credit for paying back the loan, really, is where the name would have come from?
Right. They want to make sure that if they loan us money, that they feel very secure in the fact that they're going to get paid back, because when they loan us money, that's a risk that they're putting out to us, and they don't want to do that unless they know that there's good chances that we're going to get paid back, and if not, they're going to either deny us or they're going to charge us some crazy rates.
So when does one begin acquiring a credit history?
Okay. Well, as soon as you have a Social Security number, you can pull someone's credit report, but what's going to happen is it's just going to come up empty. So when you start to have accounts that show up on there, that's when you start to build this kind of credit score. And when I say accounts, it could be anything from a car loan to a credit card to personal loans, student loans, mortgages, all different types of things. But it's those accounts that start to build your credit history.
Now, these all appear on your credit report.
Correct.
How does one obtain a copy of their credit report?
You can do it online. So what happens is there's various credit reporting agencies out there. Typically there's three. One is Experian, the other one is Equifax, and the other one is TransUnion. Okay. But a couple years ago, what happened was they all kind of got together and created one website, and it's www.annualcreditreport.com. And if you go on just that one website, you can actually go and pull a copy of all three of your credit reports.
Oh.
Or if you want, you can go on the individual sites. So www.experian.com, www.transunion.com, and Equifax.com.
How often should one review their credit report?
I'm a fan of getting a copy at least once a year. And what happens is the law says that each of us is entitled to one copy a year from each of the three credit reporting agencies. So if you want to, what you could do is stagger those out. So in January, you can get your free one from TransUnion, April, free one from Equifax, September, free one from Experian. And that way, actually through the year, a couple times through the year, it's not going to cost you anything, and you can see everything that's being reported under your Social Security number.
And if something, pops up, if you got them all three in January, and then you wait until the next January, and a long time has passed before you're able to fix that.
Right. And then if you, God forbid, you're a victim of identity theft, the sooner you catch something like that, the easier it is to fix, and the less likely it's going to continue to go on. So that's another benefit of getting a copy of your credit reports, as well as fixing any inaccuracies that you might have on there.
There's three different agencies. Are they all going to report the exact same thing?
Sometimes it'll look exactly the same, and then sometimes you're going to see some differences. So say you have a large company like a Visa credit card. More than likely, you're going to see that account show up on all three of the credit reports. But say you have a small doctor's bill from Dr. Smith down the street. Well, Dr. Smith may just have a contract with TransUnion. So if you owe a $500 outstanding medical bill, it may just show up on TransUnion and not the other two credit reporting agencies. But you don't know that, and say you just pull one from Equifax because you're going to get ready to buy a car. You think everything's great. And then you go to apply for that car, and they pull all three, and then they see these, outstanding medical bills or whatever it may be. So it is important to know that, yes, it can be different depending on the reports.
So even though it is your credit report, there might be some differences between each individual.
Yes, and there might be some errors as well, so maybe one of them has all your correct information saying that debt was paid off, but maybe the other credit reporting agency never got the correct information, or it was just kind of human error. So you want to make sure that you're really looking at all three.
Are there any costs for obtaining a copy of your credit report?
Well, we're all entitled as Americans to get a free copy once a year, free of charge. However, if you want the 3-digit credit score, which a lot of us want to know what that is, usually there's a fee attached to that. It could be $8, it could be $10, depending on where you're getting it from.
You know, we mentioned there's these 3 different reporting agencies. Is your credit score going to be the exact same score for each agency, or are there different ways of calculating it?
Yeah, they're probably going to be slightly different from credit report to credit report, because if the information that they have on there is slightly different, then that means you're going to have a different score. And their models could be, their equations or their models that they use could be slightly different. So they won't all be exactly 700, 700, 700. One may be 680, one might be 700, one might be 720.
And when you say what your score is it an average of the 3, or can you pick the highest one?
Well, what happens is when you go to a lender, a lot of times they're going to pull all 3. And depending on the lender's policy, some of them will pick the average, some will pick the highest, some will pick the lowest. So it depends. But you want all 3 of them to be as high as you can possibly get them.
Well, let's talk a little bit about what that means.
Okay.
What is the actual score representing?
Okay.
And what is the actual range of numbers that it could be?
Well, when we're talking about FICO scores, which is probably what 80% of lenders use, and FICO just stands for the Fair Isaac Company, which was the original company that put together the algorithm or the mathematical equation to come up with our 3-digit credit scores. And those credit scores run between a 300 and an 850. And how it works is, go back to high school when we took tests, right? When we got that test, we always wanted the highest grade possible, because that means we did the best. Same thing with our credit score. So the higher your score, what that means is you are less of a risk to a lender. So the higher the score, the best rate you're going to get. And if you want, I'll give you an example. Say you have someone that has an 800 credit score, and they go and they buy a new car today. They can get that new car loan at either 0%, 1.9%, excellent credit, because they're such a low risk. Any debt they've ever had, they always pay it in time, on full. However, you have client B, who unfortunately has been late on debts. Their score is hurt. Maybe their score is, a 600. And they try to go buy that same car. They could be paying, I have clients that are paying 26% interest rate on car loans, because their credit is so hurt and they've been, kind of taken advantage of. So that's the difference of, good credit, and right, that could be hundreds, if not thousands of dollars more that someone is paying for the same exact car, all depending on what these credit scores look like. So
now, the rationale for that is that the person who has the lower credit score may not pay back the full amount, and so they want to try to get as much as they can up front. Is that what they're thinking? Or?
They're thinking a combination of things. They're thinking, okay, when they pulled that person's credit score that has the low credit score, on that credit report, it must show in more than one time that that person has not fulfilled their debt obligation. Either they're running 30 days late, 60 days late, or just never paid bills. So the theory is that they're going to be less likely to pay this new loan back. So in order to kind of penalize them for that, it's going to cost them more money to borrow from this new lender. And then what's going to happen is they are going to charge them additional upfront costs that they normally wouldn't charge, the person with good credit, or charge as much as maybe they would have charged someone with good credit.
Now, here's a question. The assumption might be that the person with bad credit wouldn't have as much money and the person with good credit would, but that's not necessarily the case either, right? It really has more just to do with how consistently you've paid back your credit.
Yes, yes. And the thing is, credit scores are not perfect, right? So someone could have been in the hospital for 6 months, and that's why they got behind. It has nothing to do with them not being a responsible person, but when someone looks at a credit report, that story is not on there. All they're looking at from that standpoint is how well are you paying your other debt obligations. So that's why it's really important that if we ever have to be late, we always want to be less than 30 days late. Because if I'm less than 30 days late on a credit card bill or loan or what have you, it's not going to show up on my credit report. But once I hit 30 days late, Experian's going to know, Equifax is going to know, TransUnion is going to know, and immediately my score is going to drop and I'm going to look like more of a risk. So that's one tip if I could give viewers.
Okay.
Yeah.
And if it's that much of a difference with a car, I can't imagine, if you're trying to buy a house or something like that, it's going to have a huge impact.
Sure, sure. And sometimes people will just get outright denied if their credit is that hurt because they're considered too risky.
What is an average score considered? Not something that's super great or super terrible, but just normal for Americans.
Well, let's see. The excellent range, I would say, is anywhere between a 750 and 850. Maybe in the good is a 650 to 750. You keep kind of heading down, then you're in the fair section. And then kind of rule of thumb, which is, when people go get a mortgage, generally lenders don't want to see anything lower than a 640. So if that gives you an idea, you at least want to be a 640. Ideally, much higher.
Much higher.
But anything under that, now you're risking being denied or being charged, much higher fees and much higher interest rates.
But that's still a pretty high score. Is that normal for people to be able to do that? Obviously, I guess if they're buying a house.
Yeah, I mean, it depends on the situation, yes. But and the other good thing about credit scores is regardless of how hurt someone's credit is or how non-existent, everybody has the ability to improve their credit. It's not going to happen overnight, but with time and making consistent payments on time, anybody can get their credit score up. They just have to be patient with it, that's all.
Is there a specific way that the actual score is calculated? I mean, I know that we talked about how different the three reporting agencies are, but...
Yes, so to kind of give you a rule of thumb, imagine a pie chart, right? The biggest piece of the pie, which represents 35% of your credit score, is based on your payment history. So that's where you get the biggest bang for your buck, so to speak. So what that means is you have to have open accounts that are open and alive that are being paid every month on time. Rule of thumb is people want to have at least 2 to 3 accounts that they're paying every month on time. And that's like, I use the analogy, putting gas in your car. If you don't put gas in your car, the car's never going to move. So same thing with your credit score. If you are just not paying anything or have no accounts, score's never going to move forward. So doing that is going to definitely help drive things. The second thing that I would say, the second biggest piece is 30% of that pie is your credit, what they call your credit utilization, which is just a fancy way of saying how much your limits are versus how much you owe. So I'll give you a real simple example. You have a credit card and your limit is $1,000 and you owe $900 on there. What's going to happen is someone's score is going to drop as a result of that because from the credit reporting standpoint, you look like you're maxed out, right? You're too kind of close to the limit. So the kind of game piece or the rule of thumb is you never really want your balance to be more than 50% of the limit. So if you can make payments on that debt, get it down to 500, score starts to go up. Keep making more payments, get it down to 30%, which would be $300 on that $1,000, score keeps going up. So it's all really just understanding the game of credit and how it works.
So your score can be kind of fluid.
Oh, yeah.
And some of these strategies that we're going to get into right now, repairing your credit, are ways that you can take what would be a bad score and turn it around if you have a situation that you need, such as you want to buy a home.
Yeah, and I've counseled people that have filed bankruptcy, which is one of the things that can hurt your score the most. And once they've learned the right steps to take, their scores are in the 800s.
Wow.
So if you can do it after bankruptcy, anyone can do it.
So let's talk a little bit about how a credit score is compromised and then how we can repair the compromise.
Okay, so some of the things that have the negative impact is not having any accounts open, right? Because then we're not putting any gas in the gas tank.
Gotcha.
The other thing is being more than 30 days late. They're definitely something that's going to have a big negative drop in your score by doing that. Obviously, if you're 60 days late, 90 days late, it's going to have a bigger impact. So you want to try to avoid that as much as possible. Being too close to your limit, kind of what I mentioned a few minutes ago. If you're over your limit, that's going to drop your score. If you're too close to the limit, that's going to pull you down. So there's some of the main kind of items that are going to have the biggest impact. And obviously, if your house goes into foreclosure or you file bankruptcy, they're going to have a really significant drop in your score.
Suppose someone has been rather conservative in their borrowing, if you will. They have credit cards, but not a whole lot of debt. Do you have to have a certain amount of debt to have established that you're going to be a good risk?
It's not necessarily a dollar amount, but I would say I'm going to go back to having at least 2 to 3 different accounts so that you can show that you can manage, the various obligations that you have.
When we talk about repairing credit, what is the best method? Is there a best method for repairing credit?
It really depends on the person's situation, how much they owe, how old the debt is, who they owe the debt to. So there's different strategy depending on the person, right? But the main thing is if that person is running behind right now, if they are running 30, 60, 90 days late, first thing they need to do, they need to get everything current. And they need to stop any delinquencies that they might have, as soon as they can. If they have student loan debt and they just can't pay because they're unemployed right now, don't just not pay. Call the student loan company and put it on deferment. If they can put it on deferment, it won't have that negative impact on their credit score. So stopping any of the bleeding, so to speak. Making sure that they're not closing accounts, because once they close accounts, that can have a negative impact on their credit as well. Keeping those, what I keep saying is, keeping the balances at least 50% of the limit. So if they are someone who's maxed out, pay extra every month, as much as you can to get that balance down. That's gonna, help your score rise significantly depending on, how often you can do it and how much you can pay down.
Okay, now you mentioned closing accounts. Now, from my perspective, I would think, I don't want to have extra debt or maybe a temptation.
Right.
So what is a credit agency thinking if I'm closing an account?
Okay, so remember that pie chart that I mentioned a few minutes ago, that 30% based on your credit utilization? Well, they look at your account individually, but they look at your account in an aggregate amount as well. So say you had, I'm going to use example 10 credit cards, and they each had a $1,000 limit on there, and you owed $1,000 today. You look pretty good because you only owe $1,000, you still have another $9,000 available. Okay, you only owe 10%.
Okay.
Great. Tomorrow you wake up and you don't want to be tempted by any of these credit cards. I'm done with the credit cards, and you close 1, 2, 3, 4, 5, 6, 7, 8, 9. Right? So today you owe $1,000, but now you only have a $1,000 limit. So now you're at 100% capacity. You've borrowed the full amount that's available. So now all of a sudden, although you don't owe $1 more than you did yesterday, because you closed all those accounts, you look like more of a risk. Your score is going to drop.
Got you. So it really is about knowing the strategy and how to make it work to your advantage.
Yeah, and understanding what the credit reporting agencies are looking for, because sometimes the way that they look at things are different than we would as a consumer. But back to your point, if you are someone who is going to be tempted by those credit cards, and you feel like you're going to get yourself in debt, it may be worth it for you not to have it or to put them in the freezer or do what you need to do. I'm not recommending that anyone go into debt. That's not what I'm saying at all. I'm just saying, use credit and debt as a strategy to improve your credit. And if you have credit cards, you can pay them off in full every month. You don't have to pay any interest, so it doesn't even cost you anything.
But it really is a strategy. So if you know that it's a strategy, instead of doing what seems like common sense and, really hurting yourself in the long run, if you can leave it open, it does make the picture look better, so to speak.
Yeah, for most people, yes.
There's probably a lot of false information floating around, but we have a couple true or false questions, such as that negative credit can be removed from one's credit report by writing a letter to the credit agency. Is this true?
Okay, so what happens is, say you have on your credit report a debt that says that you still owe an amount that you don't. You have the right to dispute that information with the credit reporting agency. But if that information is right, it's going to stay on your credit report. The only way that it's going to come off is if it's inaccurate information.
Okay.
So that could be a little misleading. You can't just tell them to take negative stuff off, only if it's not true.
Oh, so it's untrue negative stuff, but even things that if you did it, and it's making you look bad, it can stay on your report because it is accurate.
Right, right. And what the other nice thing though too about your credit report, it is forgiving. So certain items are only going to stay on there for a certain amount of time. A lot of things after 7 years will come off your credit report. So that's good news also.
Credit scores can be greatly improved in a relatively short period of time. True or false?
For most people, it's not that quick. For a lot of people, it takes time, right? It's all about consistency and what they refer to as behavior patterns. Now, if you have a $5,000 debt that it's showing outstanding on your credit report and it's not yours, you know, maybe it was your mom's or something like that because you have the same name, and you go and dispute it, yeah, that's going to have a quick, impact. But if it's a $5,000 debt that you owe it, you know, it's going to take time for you to pay that debt down and for your score to eventually go up.
But if you're just a normal person, you know, consumer, and you say, okay, I'm going to open a few accounts today and I'm going to work on my score, like we had been talking about previously, it's not going to be overnight that all of a sudden you have an 800 and
right.
Woohoo!
Yes, yes. It's all about behavior patterns. A lot of times, you know, it may take 6 months for you to start to see significant difference, sometimes a year. But I would say within 2 years, people can make a huge positive impact.
So if somebody wants to, you know, upgrade in terms of a car or certainly buy a house, this is something that they really need to be working on well in advance.
Yes, yeah. And that's great advice. Yeah, the sooner you can get your score up and start working on it and doing all the steps that you need to, when that time comes for that car or, you know, for that that mortgage, you're going to get the best rate that you can. And if you're tying yourself into a 30-year mortgage, you want to get the best rate that you can.
Well, we talked about this one a little bit, that a negative credit score can cost someone a lot of money over a lifetime.
Yes, very much so. I gave you the example a few minutes ago of just someone getting a car at 0% versus 26%. I do an example in some classes that I teach about two people buying a $100,000 mortgage, and the one person has great credit and the other person has really hurt credit. The person with really hurt credit could be paying $40,000 more in interest than the person with good credit buying the same exact house over a 30-year mortgage. That's a lot of money.
That is a lot of money.
Yeah.
And there are also, you mentioned, there could be additional costs up front because the people are, you know, trying to get as much as they can from the risk factor.
Yeah, and we even see it when people turn on their utility bills. You know, if you have good credit, maybe you don't pay any security deposit or very little. If you have hurt credit, you go turn on your utility bills, they want a couple $100 security deposit.
Really?
Or when you turn on your cell phone, or your car insurance. You know, you've never been in a car accident, you get a great rate, and you have good credit, and you've never been in a car accident and you have hurt credit, you could be paying $600, you know, a year more in premiums just because of your credit score.
So these are all things that we don't even really think about as being linked to our credit reports, but they're all having
an impact.
And possibly additional fees costing us money.
So imagine that, you know, that burden that people are carrying, everything that they're doing, whether it be buying a piece of furniture on their credit card or turning on their utility bills or buying that car, everything is just more expensive. It adds up.
Are there a lot of errors commonly found on credit reports?
Unfortunately, there are, and that's why we also recommend that people pull a copy of their credit report, pull all three, make sure you clean that all up, because sometimes those errors are bringing your score down for no good reason. And why do that to yourself if you can just take a few minutes and, you know, dispute it and get that corrected.
And what is the best way to dispute that?
If you're pulling your credit reports online, you'll have access to do the dispute right online.
Okay.
So you could do it that way, or if you want, you can do it, you know, the old-fashioned way and just, you know, write a letter and send it to the credit reporting agencies and tell them, you know, this is incorrect. And I would also recommend sending it certified mail, so that you have documentation to prove that they received it. And they have 30 days to, you know, fix any errors or disputes. So within 30 days, you'll start to hear back from them, you know, what came off the credit report, what didn't, what have you.
Do you have to include documentation that shows why that was an error, you know, some sort of proof?
You actually don't have to, because it's up to them to go and dispute it with the original creditor. If you have documentation, by all means, you can send it. Some people do both routes, where they'll send it to the credit reporting agency, and then they'll also let the, you know, doctor's office or the credit card company send documentation there, so both of them are aware. So it's whatever you choose.
What are some of the pros and cons of doing it yourself, so to speak, when you're trying to repair your credit?
By doing it yourself, it's going to save you some money versus paying some agencies that are out there that may cost, an expensive amount of money. Rule of thumb is we usually tell people these agencies can't really do anything for you that you can't do yourself a lot of times. And it's a lot easier than people think to dispute information. They think it's going to be this very difficult, time-consuming, and it could take 10 minutes, if it's something, that simple. I mean, there's going to be times where things are going to be more complicated. But it's also a way for them to kind of just be more in tune with what's going on with their finances and their credit, and just be more kind of self-aware of the choices that they make, and being aware of the different decisions that they make and how it's affecting their credit.
So really, if they're doing it themselves, it might actually help them in some ways, because they're becoming more proactive and more hands-on, and they have an understanding of the process instead of just saying to somebody else, here, fix this for me.
Exactly. And they're going to be more aware when their bills come in, making sure not to, just put them aside, or, keeping proof of things that have been paid instead of just kind of tossing them. Just makes you just a little more aware.
Yeah, you understand the implications of things.
Yeah, exactly.
Now, there is some legislation that's in place to, help consumers and protect them, such as the Fair Credit Reporting Act. How can this help people?
Yeah, so what that basically does is that's the kind of umbrella over on top of the, our credit reports and credit reporting. So some of the things that law says is that as individuals, we have access to our credit reports whenever we want. We have unlimited access. It means that not anyone can just go pull a copy of our credit report. So if I want to just pull a copy of your credit report, I can't just do that. There's limitations and guidelines about, who can obtain a copy and when and how. It also gives us a right to put up to 100 words on our credit report if we want to explain maybe a time frame, maybe someone was in the hospital, or a particular account that's in dispute. So it's not going to change your credit score at all, but at least it gives someone an idea of what's kind of going on with that situation before they make that snap judgment. So it just, it also gives us the right to dispute information on our credit report that we feel is inaccurate.
That's interesting that you're able to, basically make a notation in your official file, so to speak, to explain something.
Yeah, a lot of people don't know that.
Yeah. We're all out of time for today. But if our viewers, they want more information, is there a website they can visit or
Sure. Our organization does something called credit report counseling. So we pull all 3 of their credit reports, go through it with them, give them step-by-step on what they need to do to improve their credit. They can either call us at 1-800-989-2227, or they can visit our website at www.clarifi.org, which is CLARIFI.org.
Okay. Awesome. Stephanie, thank you so much
You're
for sharing
welcome.
with us today.
Thanks,
That was fascinating.
Oh, good.
Thank you all so much for tuning in. I hope you learned something, and we'll see you next time on Joy in Our Town.